How was the SOBR stop invented? This is Bill Scheid from Applied Finance Research, and that's the question we're going to answer in this video. So first of all, SOBR stands for Shot Over the Bow Rule, and it is a volatility-based stop. So how was it born? Well, over the years, over the decades really, trading monthly asset allocation systems, there were a number of occasions when there was a sharp and sudden market shift. And on those days, my spidey sense, my intuition immediately knew that something had shifted in the markets and I no longer wanted to be holding equities. It was like somebody broke the stock market. It was a sharp and sudden shift, and it definitely made me feel uneasy. So I began noting these occasions, I began writing them down, and when I had enough of them compiled, I started researching to find out what technical elements these days all had in common. What was it about these days that rang the alarm bell for me? Could I quantify a common element between these days? And I looked at all kinds of different data to try to find what lined up, what was similar. And I found that one thing that all of these days had in common was that they all involved a drop of 3% or more in the S&P 500 on a daily close to close basis. So that became the foundational rule around which the SOBR stop pivots. Now, of course, there's more involved than just that, but that is the keystone. Now, where did the name come from? The name Shot Over the Bow came from a phrase that Ken Long said. He actually coined the phrase, and I think he did it quite accidentally and unintentionally. On one of these days, on one of the SOBR days, I was watching Ken Long's daily podcast, and he happened to mention that the price action that day was a shot over the bow for equities markets. And that name matched exactly what my spidey sense was telling me. Hey, this is a warning shot, and there are more drops to come. And so after researching the commonalities of the days and defining the rest of the specifics around the stop rule, I started calling them SOBR days, shot over the bow days. Now, an interesting piece of corroborating research for you. After creating and implementing this rule, using it for quite a while, I learned later that Investors Business Daily has a term called vertical violations. And vertical violations are days in which the S&P is down over 3% on a close-to-close basis and breaks through the 50 or 200 daily simple moving average on high volume, low close bars. IBD found that these days occurred during most of the biggest corrections of the past 40 years and are a warning that there's going to be continuing decline ahead and that the decline is going to be larger than normal. Now, because IBD includes that break through the 50 or 200 daily SMA, these vertical violations, as they define them, they tend to happen after a correction is already clearly underway. Now, we don't use the 50 or the 200 as a requirement for SOBR days because we don't want to wait for the correction to be clearly underway. We want to get out at the earliest warning. In other words, we want out on a shot over the bow, not after the shot has already smashed the hull of our ship and we're sinking. In my research, I found that SOBR days have happened 77 times between January 1st of 2000 and September 1st of 2023, and that the pattern is that they tend to cluster. They tend to cluster. Why is that important? Well, it's important because it means we want to get out on the first one and we don't want to stick around holding equities if there are more SOBR days to come. I particularly like that acronym, and it works because it sounds like the word sober as it applies to alcohol. It's like when one of these days happens in the stock market, the party's over, it's time to sober up, the last keg of beer just ran out, and the cops are on the way. So that is the birth of the SOBR stop. And also the SOBR stop is related to our optional short positions. So not only does the SOBR rule impact when we get out of holding equities on the long side, but it also impacts when we get in on the short side. So it's really quite a fascinating story in terms of how it was invented, and has some really fantastic applications, practically speaking, and generates some great results with our monthly asset allocation systems. This is Bill Scheid from Applied Finance Research. Thanks for watching, and happy investing.